My guest today is calling it the most risky time in markets and geopolitics. Bert Dohmen is the founder of Dohmen Capital Research, and he brings decades of expertise to guide investors through turbulent financial landscapes. Since 1975, his flagship Wellington letter has delivered sharp, contrarian insights, spotting critical signals like the recent Russell 2000 short squeeze and the VIX's climb above 15, hinting at potential S&P 500 sell-offs. We're going to get more from Bert today. He is joining us and is warning about the economic risks in the system right now. Bert, always good to see you. Welcome back to the Daniela Show.
Thank you. It's great to be with you, as always.
It's interesting. I've just been having guest after guest echoing this message, and it's terrifying me that it is the most risky time in the markets right now. Bert.
Yes.
Talk to me about what you're seeing and why you have made such a bold statement here.
Well, we look at the statistics. They don't show them on financial TV. But for example, the valuation of the NASDAQ composite is now as a factor of GDP is at the highest ever. So this is the highest valuation of stocks in history. And when you look at the economy, you just wonder, is that even justified? But it happens because the Fed is pumping out all this money. Don't ever believe what the Fed says. They say they're practicing a tight money. That's totally absurd. Money supply M2, the latest number is August 4th, is at a new all-time high. They've been manufacturing more and more money on top of the trillions that they manufactured during the COVID crisis. This is what's fueling the stock market. So you don't have to really look any further about the stock market. You don't have to think about the price earnings ratios and is this a good product and so on. These are all ripples, What you want to look at is only money. Money drives the stock market. And I developed the theory, I call it the Dohmen theory of credit and liquidity. And that is all you have to know to see if the market is going to go up or down. You look at what is the trend of liquidity and credit. When they're contracting, the stock market will go down. When they're expanding, the stock market goes up. It's that simple.
And what's the signaling right now?
It's expanding. That's why the market has been going up since April. It has been expanding. But of course, there's always the delayed factor. So it's not a timing device. It's just that when it reverses from expanding to contracting, you better find the exits.
Yep. Well, on that note, you say speculation takes money. And let me just read this from your recent newsletter. You said, as we have written over the past weeks, speculation is insane, as we have seldom seen it. Margin debt on the New York Stock Exchange is now over $1 trillion. 1 trillion. That's a record. You say, imagine when the margin calls go out and Wall Street starts foreclosing houses because investors cannot come up with the money to meet the margin calls. Who will buy the stocks that investors must sell because of margin calls? This is reminding me of another period we have lived through. Bert, what are we up against here?
Most people that have margin accounts, and it used to be you needed $5,000 in the account, margin account, so that you can borrow them against the stocks that you buy. And the experience that I'll never forget was in 1987, after the October crash in the market. During that crash, the Dow Jones Industrials declined 22.6% in one day. It was horrendous. And we had a meeting, coincidentally, with a top Wall Street guy who was vice president of a well-known Wall Street firm. And he said, yeah, I'm traveling all over the country. And so I said, what makes you travel so much? He said, foreclosing houses. I said, I didn't know you were in real estate. He said, we're not. These are people that cannot meet their margin calls. Can you imagine? I bet you ask any person with a margin account, and ask them, "Do you know that you can lose your house if you can't meet your margin call?" They don't know that.
I would think the majority probably don't know that, Bert.
They don't. They don't. They have no idea. And now they're buying these double and triple leveraged ETFs. They're buying 1 day options. The option starts trading in the morning and it dies that night. I mean,
Oh
this
my
is
gosh.
insane. This is totally insane. This SPACs that they're selling, no value. Look at even the recent offering of the Trump sons, of a Bitcoin firm. It's insane. Suddenly, at the end of the first day of trading, was worth $2.1 billion. From basically nothing. I mean, these are things that are warning signals. Things don't go to the sky. And eventually, reality always returns. And the higher you've gone before that reality returns, the bigger the crash. So this is something that you have to consider if you're in the stock market.
I know offline we were talking about that interview I did with Mitch Wexler, which you appreciated on property taxes, but he also brought up something that you just made me think of when he said, at the end of the day, we just don't know who our banks are in bed with. And this made me think of that, Bert.
Yes, exactly. I mean, one great tip off for what the big knowledgeable firms are like BlackRock, they're all getting out of private equity. And so that's why you see all the publicity about private equity, how great of an investment it is. You should buy them for your 401k, all private equity. That's because they need buyers for the stuff they want to sell, you know. And the public is always elected as the back holder. On the way down of an investment, somebody has to hold those stocks, okay? And the public is the bag holder on the way down.
I'm sure you saw the headline now JP Morgan's CEO Jamie Dimon is saying that the economy is weakening. I know you're probably thinking you've been saying this for a long time, but I want to bring up another part of your newsletter where you say an interesting chart that you saw compare the Nasdaq's market cap relative to the US M2 supply since 1990. You say currently the ratio is up to a record 145%, officially surpassing the peak of the year 2000, the dot-com bubble. Since the 2022 bear market low, it has more than doubled. That is a mark of insane speculation. Periods like this don't end well, as the year 2000 showed. Bert, another major red flag here. Whoa, let's stop here for just a moment because this is critical. When the next financial crisis hits, accounts will be locked just like 2008, and it will be too late to do anything about it. I've reported on global markets for over 20 years, and what's happening right now is unlike anything we've faced before. The window to act is closing fast, and the opportunity is now. That's why we've created the Private Wealth Playbook. It's free and it shows you how to move into the proper gold and silver strategies, proven to protect and grow wealth when everything else breaks down. Don't wait until after the crisis hits. Click below or go to DannyReport.com and download the Private Wealth Playbook right now. Now back to the show.
The longer this downturn or this upturn in the market lasts, the worse it's going to be. In fact, right now we're seeing signs that the major indices, and I'm talking about, we look at very much the equal weighted indices. That's what you want to look at. There's an S&P 500 that everyone looks at, but there's also an S&P 500 equal weight where every stock has the same weight, no matter how many shares are outstanding. So more truly reflects the average investor's portfolio. And they are giving signals that, if you're in a market, you should really heed and you should start looking at where the exits are. Because when
Start
everybody
looking.
wants to exit, it's going to get very crowded.
So, Bert, talk to me about assets you do like right now.
The one sector that we like and have been in is gold and silver, and because they will retain their purchasing power. because the whole thing here, the whole world is in the same fix. Europe is just crumbling as we watch.
Yep.
The EU is probably going to go out of existence. Nobody pays attention anymore. The EU has totally exceeded its authority, and so on. So people want to get out of it. When the large countries have their own problems, they're going to get out of the EU. So the EU is crumbling. But it's being touted as, oh, the EU stocks, buy EU stocks. Of course, they want you to buy EU stocks because the people who tell you they are selling it. They need to rip up the buying. That's what it's all about. Always think of the stock market as a game. The average investor is a sucker, and there's an old saying. I used to play a lot of poker in college. And it said, if you look around the table and you don't know who the sucker is, it's you. And so that's really how it is in the stock market.
And I know you don't like Bitcoin, right? You see it as a risk asset. You saying it's now down over 13% from its record high set on August. Why don't you like Bitcoin?
Well, let me ask people that have it, why do you like it? It's just a number. Is there any intrinsic value? Can you take a Bitcoin and buy a loaf of bread with it? I mean, what is the need? Do we really have a need for a digital number, which then says you theoretically own this amount of Bitcoin? Theoretically. And if suddenly that vanishes, where do you go to complain?
Hmm. I guess
Huh?
the question
Where's
is,
the complaint department? Where's the support? There isn't any.
Bert, what about the fact for you, the aspect that this administration seems very, favorable to crypto? So many
Oh,
people are,
there you go. That is the one factor. The current administration has selected this as the sector where you can make what they can make billions of dollars for themselves. Okay. So this is going to stay. It's a big, big factor. And the whole family, of course, is involved. And so that will give it more life than normal. We already have a law now that prohibits the Federal Reserve from issuing a digital coin, and so that gives the private companies that will issue stable coins an advantage. The Federal Reserve cannot come in and compete.
Bert, bring it home for us then. A lot of good nuggets today. Obviously, I urge everyone to get the Wellington letter. It's phenomenal. But what do you want people to know most watching at home?
Well, I think the most important thing is ignore what everybody says. We have a rule. Whenever our view of the future starts getting very popular, then we know we have to change. And then we start looking. Okay, where could we be wrong? That's always the important thing to ask. And what do we do if we're wrong? Okay, so this is what you want to prepare for. The one thing that's really important is the only thing that's really important is the trend of money and credit availability. When the Fed says they're tight because they're raising interest rates, higher interest rates are not necessarily tight money. From 1978 to 1980, money supply grew double digits. Okay, and we had forecasted that based on what the Federal Reserve told us. He said we will not tighten money. We will raise interest rates or use the interest rate policy to fight inflation. And we said that means inflation has green light ahead. We're going to have a double-digit inflation, double-digit interest rate. We even forecasted 20% prime rate, which then happened in March of the year 1980. So it happened. We got double-digit inflation. The yield on long-term T bonds was 15.25%, 100-year high. People don't remember that. I remember well because we were short. Bonds were tanking. And then we had forecasted a 40 to 50% decline in U.S. Treasuries. Wall Street called that crazy. They said our financial system could never take that. But it happened. The Treasury bonds went down 44% in price, not yield. And so when they did reach that 100-year high, then Paul Volcker came in and says, his mission was to kill inflation. That's it. This is the time to buy bonds, okay? Because a 100-year high in yields of T bonds is not going to last. They never last. And so then we turned around and we started buying T bonds. And we had one client, he was a big developer. He has a 3,000-acre luxury home development in Orlando. And he said, what do? I need some money to pay for the making the infrastructure. So I said, well, we gave opportunity of a lifetime bicycle on U.S. T-bonds. So he leveraged T-bonds. He used 10-to-1 leverage, which was higher than what I had recommended. But he put $10 million into it, bought $100 million worth of T-bonds. And T-bonds, of course, soared in value. Over the next 40 years, actually, the zero T-bonds went up 40 times. 40 times. People cannot imagine it. But, zero T-bonds, they have the coupon clipped off. So in effect, you get leverage when you buy them. So it
Bert,
was an exciting time. And we're going to have some really exciting times, some fantastic times to make money if you know what to do.
if
And
you know what you're
I
doing,
don't see anybody on financial TV, for example, even talking about this kind of stuff. But you have some of the guests, like Wexler. It was fantastic what he said about
Thank
property
you.
taxes
Yes.
and so on. Yeah.
I have the best guests. I'm so fortunate and blessed. Thank you so much, Bert.
My pleasure.
I urge everyone to get the Wellington letter and to reach out to us at ITM Trading, especially if you're thinking about purchasing and setting up a strategy based on owning physical gold and silver. They'll get you started with a free strategy session. Tell them I sent you. They'll take great care of you. And as always, please subscribe to our channel, and we'll see you all soon. Thanks for watching.